Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumina Wealth, where we specialize in the craft of alternative investments. At Lumina, we help guide clients through the intricacies of managing wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their clients so that you too can invest beyond the ordinary.
It's the next episode of Lumina Non-Consensus Investing coming at you Sunday night, 6 p.m. Eastern Time. I managed to negotiate some time to catch up here. It's been a while, been on the road quite a bit. Have done something like 18 FSD live streams on Twitter. So I've been trying to keep people informed around what we're seeing, what we're up to, but it's good to get back here also. So I hope everyone's doing well. Thanksgiving's coming up. It's my favorite holiday. Really looking forward to that. I'll be spending time in upstate New York. My mom loves Thanksgiving. She makes a lot of pies, rhubarb, pumpkin, apple. I eat all of them. And each Thanksgiving, I buy a new board game. So if you have any recommendations, let me know. If you're looking for a gift for somebody, by the way, you want to get them involved in markets, here's a good one. This is from the bookshelf. Jack Schwager, Stock Market Wizards. This is the original OG version. You can see it's been read a few times here. It's a good book. So anyway, that's one that might give somebody the bug. And some movies I like and recommend. Classics are ideal for the holiday season. Indiana Jones is a good one. Raiders of the Lost Ark, maybe. The Departed. If it's mostly guys, you can do Sicario. If it's a bigger group, you can do something like Family Man, get in the holiday season. Those are some good ideas for everyone. So I wanted to get into some themes we're looking at, our views on the economy and some stocks that we're buying, and maybe share a bit more about our weekly process. I've never really done that, but we could spotlight a few things there too. What else? Another thing is we're doing a lot more events. We had a great event in New York City. It was someone who was a member of our Telegram group, and he was very kind and gracious and offered up his beautiful penthouse apartment in Soho. And we had about 40, 50 people in attendance and met a lot of people that I don't know who they are in Twitter, but met them in real life. And they're entrepreneurs, they're investors, they're professionals, they're enthusiasts, they're techno optimists. I found they care about health and longevity. And it's really interesting. I think we've stumbled upon something here where people have like-minded values and interests, and they want to get together and talk to one another. So we're going to do a lot more of these events. Stay tuned. We'll find a way for you all to plug in to that. We'll start in New York City and Miami and maybe Dorado, Puerto Rico. That's the triangle, with some occasional stops in Austin, Texas and San Francisco. And maybe, just maybe LA too, if we can pull that off. But I'm excited. We're doing a lot here. We have an AI app in our app store now. It's called luminacopilot.com. It's in the test flight in the app store, I should say. So if you get a test flight, log in by reaching out to us on Telegram, or you can DM me on Twitter or email info@lumina.com. We can get you test access to that before it launches. But it's an app focused on investing. I think Robinhood is focused on trading. You get the confetti pop when you buy or sell something. This is about investing. You get the dopamine when you have an insight, when you have research. I'm starting to use it every day now. That's the real measure of value add. If I start using it every day, then I know people that value the kinds of topics I value will seem interested in it. So I'm looking forward to that. So stay tuned for that. Go to luminacopilot.com and you can get on the wait list, or again, reach out to us and we can get you an early test app. It is really something else, though. I'm very happy with what our team has done. And in the spirit of gratitude, grateful for the team, grateful for the community we've built. And thank you for tuning in and spending some time with us. Nothing more valuable than your attention. Hopefully we are delivering value. All right. With that said, let's dig into it. The headline of our newsletter this week was called The Revenge of Warren Buffett. So it's kind of this joke playing on the concept of that quality stocks are, at least some of them, are finally beaten down and they may be worth a buy. And the interesting thing about quality stocks is they're the exact opposite of animal spirits, which have been the strongest performer year to date, at least through October. and they've got smashed in the last 30 days. Doesn't matter whether it was a digital asset or small caps or like uranium, kind of everything but biotech, actually. Biotech technically is animal spirits, by the way, but that one did not get smashed here. But yeah, we think there's some rotations happening back into quality names. And we'll talk you through some of the names that we bought, how we thought about them. Some of them are in our newsletter as well, just sharing our thought process there. On the big picture, we still see this as an economy that's fine and it's growing. Productivity growth is solid. Labor market's healthy. There's a demand for talent and it's hard to find great talent. That's the big issue in the labor market. You've got students graduating with obscene levels of debt, with unproductive education. Like those are issues, sure. But overall, the economy is growing. We see in the earnings reports, we see it across categories. Earnings is there. That's the number one thing to look at. And related to that, there are a few number one things to look at. Earnings, inflation is coming down and will continue to come down, especially with Trump walking back tariffs. And I think a lot changed after these recent elections. There's a lot more of a conciliatory tone. It was surprising / shocking to see Mamdani and Trump in the Oval Office. Like, huh? Did I wake up on a new timeline here? What's going on here? What's going on here? But disinflation is here. That's important. And you still have the Fed that has a bias to ease. You've got a baby boomer economy. That's where the bulk of the spend is coming from. Remember, the bulk of spending in the US economy comes from like the top 1/3. They explain something like 2/3 of spending. And that spending is resilient because it's driven in turn by transfer payments and returns on things like T-bills and Medicare, Medicaid, and Social Security, et cetera. So this is a services economy now. It's a much more stable economy, and you've got all this CapEx that's happening too. So think about every element of the GDP equation. Government spending is up. I'd rather see more restraint, but government spending is up. Investment is up. The consumer is solid. So it doesn't mean that aren't issues like housing affordability. The fact that people can't buy a house means they spend on other stuff. That's the funny thing about markets, right? It's easy to spot the thing that's broken. You have to find the thing that is benefiting as a result of that, right? In economics, they call that equilibrium. So if they can't spend money on a house, what are they doing? They're buying lottery tickets. The modern equivalent of lottery tickets, animal spirits, right? Kind of half joking, half not joking, maybe both. I don't know. Depends on what we're talking about. Because some of those themes I think have legs actually, but a lot of them don't. And yeah, I think you're going to see continued spending on travel and leisure and other areas. In the newsletter, we go through this in a lot more detail, by the way. So if you want to get more analytical rigor, I would look at that. I think there's a lot of fear out there. There's plenty of wall to climb. There's definitely a wall of worry. And yet, when you look at the fundamentals and what matters, things are pretty good. I wouldn't be surprised if we get to all-time highs by year end or sometime thereafter. I think positioning will be a bit different this time. I think more of an emphasis on quality names and maybe even small cap value, and a higher conviction on consumer discretionary and these kind of communication stocks too. So that's where we're focusing. But yeah, I'll share my screen briefly here. You guys can take a look at some of what we've highlighted in our weekly newsletter. I think if you want to be a better investor, you should read this. It's really good. It's a labor of love. We've grown our analyst team. It's a lot in here. But you can see the earnings momentum is quite strong. You need to see some kind of shock to earnings, unlike 2021, which was fueled by back-to-back $1 trillion stimulus checks. We don't have that here. This is organic. So it should continue. The beat rates are strong. The labor market is solid. It's growing at a lower rate because of less immigration. That's not a recession. And initial claims are one of the fastest reads on deterioration. And you can see the moving average is fine. It's more than fine. The big thing turning on markets now is like December rate cuts. So I'll give you the tactical view and the big picture view. Let's start with the big picture first. In the big picture, it really doesn't matter. If the Fed were to cut 25 rates, that's not a meaningful impulse to the economy. it really doesn't change that much. Sure, the borrowing costs drop on the short end of the curve, but only by 25 bips. It's not going to make a material impact to decision making. Okay. A lot of this is like high theater and high drama. That's what this really is. People obsess over the thing in the news. Like, what's the thing in the news? They over-focus on that. By the way, lower short-term rates also mean less income for baby boomers who are driving the economy and doing a lot of spending. So I think these decades-old ways of thinking about the economy are not terribly relevant in the modern era. And it's difficult for policymakers to adjust to that. Really, what you're doing when you're lowering rates is shifting winners and losers. You're rewarding borrowers over savers. So that's what you're doing on the margin. And yeah, I think you're reducing the required rate of return to have a good project. So more projects get done, more questionable projects get done also, which was what you saw in 2021 when the 10-year was 1.5%. The hurdle rate to have an NPV positive project was so low that you had all sorts of nonsense taking place, right? I'm not a big fan of how a lot of people think about rates, including this concept of the real interest rate, which makes no sense if you understand that the economy has a big component driven by animal spirits and psychology and people's optimism and attitudes towards the future. Anyone that lives in real life knows that, right? There is no R squared. There's R star. There is no R star. We've seen plenty of times where rates have been quote unquote restrictive and the economies and markets have done just fine. Don't forget 2023 and 2024 when rates were higher for longer, right? Rates were higher for longer. Think about that. You had an inverted yield curve. Rates were higher for longer. What happened? The S&P did back-to-back double-digit gains. It didn't matter. Okay? You should reflect on that. Don't zoom in and say, okay, these rate cuts really matter. They really don't. Big picture. We're talking 25 basis points. Someone paying a 29.5% credit card interest rate who gets 25 basis rate cut is actually not going to move the needle. 50-year mortgages, I see value in that for what it's worth. Put that on the record. There's value in that. Topic for another time. Okay. Tactically, here's what I would expect. If the Fed doesn't cut rates in December, then you probably get something like a retest of the local lows and you get some more panic. Maybe the VIX goes to 26, 28, or 30, and then that gets bought. So that's tactically how I would expect this would play out. It does look like we will get a rate cut, though. Fed governor came out this Friday and made some comments that were dovish. And the Fed rate cut probability went from 46% in December to, you can see it here, it's in our newsletter, went to 71%. There's one comment from one Fed official, and that sparked a 2 to 3% rally, depending on what index you're looking at in the public markets. Okay. So this is what's driving markets, this variable here. Every day, we're looking at the Fed fund futures rate probability, just to learn from it, by the way. I think it's actually hard to act on this. Here's why. If the Fed fund rate cuts probability gets to 0%, meaning there are no expectation rate cuts, then by definition, no rate cuts are now priced into the market. And if the rate cuts move towards are at 100%, then you have rate cuts and markets are lifting off, right? So the point here is that markets will price in this information. It's really the change in the probability that matters. If you ever read into that, then there's some value added here. We just went from 40 to 70%, which was bullish, right? So if you go from 70 back to 40, that's bearish. If you go from 70 to 100, that's bullish. My guess is we probably get the 100 because I don't think those comments come out of the blue. Okay. What else? There's all this talk about bubble talk. Not seeing that. The QQQ did get expensive. Let me show you. That is true. The QQQ approached levels that we last saw in around 2021. And you can see on my screen here for those that are watching. So what you see here is the forward PE on the QQQ. and we tagged 29.5. And you can see historically back in July of 25, summer of last year, you were at 29. And if you take a longer term view in July 2024, you're at 29. By the way, all these periods marked minor corrections. And in 2023, also 29 times. If I do a 5-year view in 2021, actually things got a little nuttier. This was like the age of stimmy checks. Since then, though, the markets pulled back and the forward PEs, also as a consequence of a strong earnings season, have come down quite a bit to 25 times earnings. Yeah, things got expensive in mid-October. Earnings season was also strong, though. So markets pulled back 5%, and earnings delivered even more than that level of pullback. So you've had a nice reset in valuations here. I think there's a lot of institutional memory in markets. Institutions have trauma from the dot-com era, and they remember 2021, which was in their rearview mirror not too long ago. And they all have tools like what I'm showing you right now. So they look at those tools, and when the valuations get expensive, then they sell. Notably, what we're now seeing here is a decrease in analyst estimates of future earnings. We saw that in the March-April correction. In fact, that was one of the reasons why you had a correction, because analysts are saying earnings are coming lower due to tariffs week after week. They were lowering their earnings estimates. We are not seeing that now. That's why I don't think you're going to get like a 10% correction. You don't see analysts lowering their earnings estimates. You can get rotations. You can get positioning shifts. I expect to see that. What else? On the revenge of Warren Buffett, this is a funny kind of topic, I think. So Buffett raised a bunch of cash like a year and a half ago. Then we wake up and found out he bought Google in the last quarter. That's obviously his successor, Mr. Abel, who picked that up. Google is our top position now. I think it's 10% weight. We didn't start it there, it just grew to that level. Obviously, we've been big buyers of that during this whole death of search via OpenAI. Now the narrative's flipped. Now it's what is Sam Altman doing? If OpenAI was publicly traded, that stock would be down 30% easily. It would be down just as much as these data center stocks, for sure. It would be down a lot. The funny thing I see with Google now is people are rationalizing why it's at the current level. Okay, Google's got the lead in AI. That's true. They have agentic AI. They had that. They're the leader in agentic AI, actually, for months and months. This is the team that brought us the famous Transformer paper. They also have the Broadcom custom silicon, so they're more efficient. But there's this talk about Google competing with NVIDIA. It's not going to happen. Google's not going to sell to Microsoft, Amazon, and Meta, which are their competitors in different business lines. This is not going to happen. So the funny thing about Google is we're now seeing people rationalize this thing in a way that doesn't correspond to reality. So it's the opposite of what we saw at the bottom. I'm actually thinking about trimming my Google position now. Question is then I'm going to have to pay taxes, which is terrible, right? It's another reason why I don't want to launch an ETF. I can do an in-kind transaction and not pay taxes. Tax is a form of alpha, right? Let me show you Google real quick. I didn't want to go on this Google tangent, but since I brought it up, might as well. But if you see on the screen here, these green bubbles were where we were buying Google. These match different Twitter posts if you want to fact check me. But here in April, things went really nuts. This is the correction, right? But around here, we built a very nice position. And Google can still run somewhat. It's no longer a bargain anymore. This is now running on momentum. Okay. So it's a very different proposition now. And markets pay attention to round numbers like 300. It's funny to see this at 300.85, for example, right? Up about 78% in 1 year. And it did that move very quickly in a very short period of time. The thing about markets now is that now everyone's talking about Google and it made this move in a short period of time. So the people that focus on it now are too late. It's best to focus when no one else is focusing on it. Isn't that the way to do it? It's called buy low, sell high. Now you can buy high and sell higher. I think there's actually a logic to that, by the way. That's a topic for another time also, though. I don't want to get too many digressions here. Let me take a look at a few things we're looking at. Okay, one is S&P Global. This is a stock I haven't owned it in a long time. So I put this stock in a category. It's called one of the best businesses in the world. I have a list of these businesses. Visa and MasterCard used to be on that list until the rise of stablecoins, by the way. FICO is on that list. FICO still is on that list, right? There are a lot of these amazing businesses that are just quasi indestructible because they have a dominant market leadership. They've got a great moat. They got pricing power. They're often consumer staples. They can pass inflation onto the customer. It's the U.S. Treasury is one of them, by the way. They're the best issuer of debt that the world's ever seen. Right? You can't really invest in that equity, though. I don't know what you do there, but they know how to. They have buyers for their product. So S&P Global, right? They make the S&P 500 indices. They make the licenses. Anyone that has an ETF referencing the S&P 1x, 2x, 3x, 5x, they're paying that. State Street, BlackRock, quality customer clientele. It's a bet on the growth of markets. But I look at this, how you look at a stock changes based on the nature of the stock. If a momentum stock breaks down, I'm not interested. I don't want to own that thing. A quality stock is very different. If a quality stock gets below the 200-day moving average, then I want to buy it actually, because institutions will buy it by and large. That's what they do. Okay. It's very different than, say, a random space stock. When that gets below the 200-day moving average, run for the hills, right? It's very different. So I think technical analysis plays a role, but the nature of the instrument you're looking at matters. Okay. Is it a momentum animal spirits name? Is it a quality compounder? The two, they'll behave differently. And the mistake that trend followers will do is they will sell these quality compounders at the wrong time. And that trend following is better for momentum assets, including commodities and digital assets and all sorts of things that are out there. So let me show you S&P Global. When this thing has gone below the 200-day moving average for 1 or 2 months, generally it's been scooped up. There's an exception, which is the 2022 bear market. So you have to believe that we are transitioning to a bear market for this not to work out. Okay, that's the bear case. Bear case is you're in a bear market. It's always important to highlight the bear case. And I don't believe we're in a bear market for the reasons we discussed above. Good question. Are these AI stocks like Tesla and NVIDIA quality? No. So quality, NVIDIA technically is a quality stock, actually. It's complicated, though, because it's caught up with momentum and animal spirit. So quality stocks, this is a great question. I appreciate the question. So quality stocks are what you're trained to buy in business school and through the CFA program. People that worship at the Church of Warren Buffett buy quality stocks. In fact, quality stocks are expensive because people were trained to buy them, to think and look for quality. The funny thing is quality itself became a bubble then, and therefore it stopped working, which was really funny, right? This is why I'm not a big fan of people that are like, I invest in value stocks, I invest in growth stocks, I invest in momentum, I invest in quality. They're all wrong and they're all right at different points in time. Okay. If you believe in science, why would you identify with an investment style? Wouldn't you ask yourself what the appropriate investment style is? Isn't that a better way to look at it? It's strange that we have people that are like, I invest in value, I invest in growth, it's like a religion or something. It's not the right way to look at it, in my view. That view is not consensus, by the way. But I think that is the right view to have, to ask yourself, when do these categories or styles or themes work? Which is hard to do, by the way. It's really hard to answer that question. There's a guy named Richard Bernstein, who is the former CIO of Merrill Lynch. When I was there, he's written 2 books on the subject matter. I don't know if he's done around that, by the way. I think I looked through one of his books and I read it like 15 years ago. I was like, I'm not sure it's the right way to look at it. But it's hard to do. But I think it's a fair way to ask the question. So quality stocks are compounders, meaning they can generate free cash flow and invest in themselves. They plow back their earnings, and the net present value of that investment is greater than their cost of capital. So they grow earnings. In Buffett's example, he had a farm. You have a farm, buy the land. If you plow and till the land, put some fertilizer on that, you get more output. It covers the cost of your capital. You can buy more farmland and get more output, and it keeps going and going. The same thing is true for banks and insurance companies. Those are typically quality stocks, but also businesses like Costco or restaurants, where if you open up a new storefront, then you can model out what your expected returns are. In 3 years, this store will be fully leased out or utilized, and our investment in the store is $1 million. We're going to make $3 million a year starting in year 3 when it's fully leased out or utilized, and there's a ramp up to that's net present value positive. So that's what quality compounders are. That's actually the heart of what investing is. Actually, you have negative cash flow up front, and then you get positive cash flows in future years. That's actually what investing is, which is interesting, right? But in a world of liquid markets where psychology and sentiment plays a role, prices can move for other reasons, like multiple expansion, like attention. So that's what makes the game of investing complex, difficult, fun, all of the above, right? So if you own a quality compounder, theoretically, you're going to get bailed out one day because eventually it'll compound back to your value. It's compounding book value per share. The accounting value will eventually approach your market value. I'm not saying go, but I think you have a bubble in a lot of these, like Costco, for example. I've highlighted Costco many times. I like to make fun of Costco. Costco is one of the best businesses in the world. I love Costco. I love the products. Part of this, by the way, you had Buffett combined with Peter Lynch. People said invest in what? So people said, okay, I'm going to go buy Costco stock, right? But look at Costco. Look at Costco. Someone asked me, like, what does a bubble look like? That's what a bubble looks like. Do you see that screen? Is it sharing or no? Let me show you my screen here. Okay, this is a bubble, people. This is what a bubble looks like. This region right here. Okay, you went to 59 times earnings. And now it's deflating, right? That's called the bubble in quality. That's what I mean by the bubble in quality. And you saw in other areas too, like FICO. That bubble burst in December in the case of FICO. I actually have a newsletter called The Bubble in Quality. If you want to really understand this topic, it's really interesting, I think. It was published in February 9th, 2025. This was shortly after the correction, before the big correction. That was called The Bubble in Quality. So you can take a look at this and you can see how all these things were just off the charts here. These are some of the things you can do to get a sense of where markets are. We were looking at these charts back then. We're like, okay, maybe you want to sell those names, right? People that say valuation doesn't matter, they're wrong. They're just wrong. I can show you that quantitatively too with big statistical studies. Okay, where were we? Okay, so S&P Global is an interesting idea. It's an interesting idea, I think. The thing I will share with you this, if I'm wrong on these ideas, I have no problem cutting and running because we have a lot of idea generation. Idea generation is crucial to investing because it allows you to let go of your favorite ideas. This is S&P Global. I'm showing you the valuation history of it. It's around 25 times earnings. You can see that since 2020, generally the names have been bought around these levels. Also, since 2020, since the era of quantitative easing, and stepped into a higher level of valuation than it did in prior era. Some of you probably thinking it's been lower here. That's true. You also have a lot more money floating around. The question would be, is their earnings growth slowing or not, etc. And I'll show you this, my tool here. This is our desktop tool. The UX is terrible. The mobile, I promise you, is super, super slick. But you can type in a ticker here and it'll give you the bull bear case. It's very thoughtful. This is not go ask GPT what it thinks. It's informed with multiple data sets, a factor model, and our own training. We taught the LLM how to think. Yeah, the bear case is not growing that much. It's a mature business. So it's a mature business, right? It's 5% revenue growth, but it's got operating leverage. It grew earnings 20% because of operating leverage. I love operating leverage. Operating leverage is my friend. You have this fixed set of costs. You have this product called an index. As the market it supports grows, then the marginal revenue drops to the bottom line. That's what operating leverage is. So even small revenue growth can lead to outsized earnings growth. I love that. It's great. Operating leverage is amazing, right? Coca-Cola grew with operating leverage. Banks and insurance companies that grow with operating leverage too, right? As opposed to a business where revenue has to grow at the same step as earnings. That's not as great of a business model, right? Visa's got a lot of operating leverage, et cetera, right? But you can pause here and you can take a look at the bull bear case if you want. Here's some of the transcript highlights. I love looking at what management has to say. Management says, on every headline financial metric, it was the strongest quarter we've ever had. We expect a mid to high teens growth in build issuance for Q4. Mid to high teens growth. I like that. So if I'm buying at a good price in terms of valuation, I get mid to high teens growth and the valuation stays flat in terms of multiple, then I should get mid to high teens return. If valuation moves to the range we've seen in the past couple of years, moves to the median point, then I get multiple expansion and earnings growth. Okay. Yeah, this is a neat one. It's hard to find quality stocks on sale. The market is so trained on quality. It's been so hard to find a quality stock on sale. The other one I picked up was ICE. So ICE is run by Jeff Sprecher. Fascinating history behind Jeff Sprecher. For people in Atlanta, I think you may know his wife. She ran for office. Anyway, ICE runs the largest derivatives clearinghouse globally. Look at this chart. Now, if you're a momentum trader, you're like, oh, that's a bad chart. It's below the 200-day moving average. It's going to fall apart. And that momentum trader, I believe, would be wrong for the reasons I outlined earlier. You have to treat this chart differently. This is a quality stock. It's been dislocated. This is in the category of high quality dislocated asset. That's an investment strategy. If you have a high quality asset and it's dislocated, you're supposed to go buy it, right? If the thesis of the business is still intact, then you go buy it. Historically, when you've seen this below the 200-day for 1 or 2 months in, generally it's been a good time to buy. Once again, the exception being the bear market. So unless you think there's a bear market, you should look at that. I would look at that. And if you look at the historical valuation, once again, you're at interesting levels. Again, there were better levels at the bear market of 2022. There were even better pricing then. But are you going to wait for that pricing? I don't think that's a good idea. I don't think that's a good idea because you're probably not going to get that pricing. Okay. So that was another idea in our newsletter. We had a lot of ideas in our newsletter. We talked about some fear and greed in the newsletter. I think tactically you're going to start to see a bounce. I wouldn't be surprised if you had one red day, maybe Monday or Tuesday, and then that's it. One shakeout bar to go. That's just, we had that on Thursday, by the way. Funny, right? That like inverse flip, but I think these will do well. Will they run fast? That's hard to say. I don't know, but maybe. We'll see. The other category I like a lot is consumer discretionary, especially if I'm not wrong on this idea that there's no recession. Everyone's hysterical. Markets are emotional. At the first order, markets are about emotion. Don't forget that. All this volatility, it's emotion. Okay. So the volatility around the trend. The long-term pattern is this. This long-term pattern is called earnings. Okay. That's why stocks go up in the long run, because earnings go up in the long run, right? I really like this XOY though. I'm just looking at this thing and it's so tasty. I see high in volume here on the bottom right. High in volume over here back in April. I like that. And then if I look at certain names, not buying Tesla, I love the FSD. Maybe that rallies, I don't know. Can I hold this for a year? It's not my thing. It's too expensive. I'd rather tilt towards value. But I love my old friend Norwegian Cruise Lines. We built up a position here. I think we're at 5% weight now. I love this thing. Higher lows from a broader sweep of history. And then the key thing I'll call out here is this, is the free cash flow yield is at levels we have not seen. That's a very elevated free cash flow yield. You see that? So professional investors will look at that and scoop that up. Why would you own bonds when you can buy this? It's a real asset. The free cash flow yield is higher than bonds, right? I won't walk through the thesis around this, but this is a name that that we like, and it's quasi-indexed to the baby boomer thesis, not purely indexed to the baby boomer thesis. Like Viking is closer to that, but Viking's too expensive. I don't like Viking. We looked into that. Someone, Jay, who's suggested that to me, we did a deep dive on that. A little expensive. But what else? So let's shift gears here. Let's go take a look at what else we have. Software has been a world of pain because AI has taken the limelight. Software is like high beta stocks. When I go to Silicon Valley, which I do once a year, I'll be there December 6th, I believe. Friends having a birthday party there. If you're around, let me know. I make the rounds there, but my friends in Silicon Valley love software stocks because they invest in what they know. But AI has taken the attention away. These things haven't done too well at all. So software has been a tough going, right? Look at Adobe. Remember Adobe? They got competition from Midjourney now. These things are starting to get cheap. I don't own Adobe. We have a debate around Adobe in-house, but I'd rather own, if the market sold off, why wouldn't I try to upgrade to the best names in the category rather than bottom fish? You want to buy the Mercedes in a sell-off. The Yugo is going to be dirt cheap, sure, but you want to get the Mercedes. That's the move, right? So like we bought Team at Atlassian with my free cash flow yield, very elevated free cash flow yield, right? Like almost 4%. And if I look at the valuations 30 times, the valuation's been compressing. This is called valuation compression. Amazon went through valuation compression, went from 80 times to mid 30s. Okay, that's called multiple compression. That's called a growth to value transition. You get a growth stock. It's still priced like a growth stock. It's more expensive than the S&P on average, but it's been transitioning. Now, the question is, am I buying at a fair price or am I like knife catching here, right? So a few things I'd say right away is, if this name breaks the current level, I can cut and run real quick. You see this level here? It's 100. If it gets to 139 a share, if it breaks that level, I can just exit and leave. That's what I would do here. So it's not about falling in love with your idea. I can rotate to another idea. That's it. I get a tax loss harvest. So that's my approach. You should do that. I would do that. And the idea of rotating when you have a tax loss harvest to take advantage of it, rotate. So here, this is a really interesting point I liked about, let me show you the value of transcript analysis. This is the value of transcript analysis. I'm in my AI tool. Again, the mobile version is so much prettier than this, I promise you. But let's take a look at this commentary. Why has software sold off? It sold off because of the fear of AI. But I think this business is actually indexed to the growth of AI. That creates a variant perception, which is one of the 3 ways you can create value added. Variant perception. Someone's going to ask me what the other 2 ways are. Information processing speed is one of them, and the other is providing liquidity. If there's a 4th one, let me know. So this I put in the bucket of variant perception. So here's a comment from management. Here's management. Quote, I want to reiterate from my point of view, we feel incredibly confident in our ability to deliver on what we've laid out, which is their guidance. Quote, incredibly confident. I like that. Okay, I like that. Can we expect to see more AI capabilities? Is a question from the analyst. Response, quote, I think AI is one of the best things to happen to our business. They expect to ship new capabilities. Okay, so they're being AI relevant. That's table stakes, though. That doesn't get me so excited, but it's something else going on here. I'm going to show you what they say about the AI. I read this yesterday. I want to share it with you here. First off, they got a lot of free cash flow. They got a lot of buybacks. It's a good business. They've got earnings, the dominant market leader, right? Who doesn't know Team? These engineers getting laid off, they're going to go start AI startups and they're going to go rent Atlassian. That's what happens, right? We are very excited about the strategic opportunity of AI and Robo. That's funny. The basic point here is that I believe they're levered to AI. Their net revenue retention rate is 120%. That means they're landing and expanding with their customer base. They have AI user growth. One of the products has grown 50% in the quarter. $5 billion in revenue, $1.4 billion in free cash flow. It's a rule of 40 stock also. That seems like worth a shot. Does it not? Seems like worth a shot. So I'm not fully sold on software, but I look at the valuation on this thing. Like that is probably bottoming around here. We'll see. I think there's an edge here. There are a lot of interesting stocks out there. More and more software names are starting to look interesting. I don't know that I'd want to touch Salesforce. The funny thing though is if you look at Salesforce, gee, that kind of looks like a good entry too, technically, doesn't it? So here's another thing that we do is I'll look at the theme. I should say we will look at the theme of an analyst team here. And if I see multiple names in the theme setting up, then I get excited about the theme. I've been bearish on Salesforce. Actually, if you go to my Twitter, making fun of Salesforce for the last 2 years, it's gone nowhere. Look at this, it's gone nowhere. Back to where it started. But now it's at 19 times forward PE. Again, I don't know that I'm buying Salesforce, but 6 times free cash flow. Like the meme gets priced in. Maybe the meme of AI destroying SaaS got priced in. So you got to be mentally flexible, right? You can't fall in love with your theme or your idea. Sometimes you got to take the other side when one side is too crowded, which I believe is where we are now. Okay. Here's another one I'm looking at, by the way. I don't own this yet, by the way. I do not own this one, but I'm sure there are engineers in there. We have a lot of like technical engineers and founders listening to our show and builders of the future. But in my prior startup, PureIQ, I sold that business. My CTO used Elastic, and Elastic is like a kind of a modern database for accessing non-structured information. This thing sold off 15% on Friday. I'm not sure why. So one of our analysts was researching what happened there. So I want to understand that. I think it was a small miss, or maybe we can take a look real quick now. Actually, why don't I just take a look? We'll use our technology here to go do that, right? Our analysts actually would go do what I'm doing. I just go look at the technology. They'd go here. In fact, the way we have this set up, by the way, is super cool. We have a Slack channel indexed to each stock, and we have a bot. When earnings are released, it'll give us the highlights with the green, yellow, red and the key bullet points. If you guys want that tool, let us know. We actually have that available. We haven't offered that, but that technology we've already built. So if you're a professional, we thought the market size would maybe limited that. I don't know. If you're a professional investor, you want to play around with that, you can integrate with your Slack, let us know. But so here's Elastic. So this business is growing revenue 16% year over year. So it's below 20%, which is when certain growth investors will start to check out. They beat the high end of guidance across all metrics. So that looks like a good story. It might have been an overreaction. They started a 500 million share repurchase program. They're buying their stock. Their net revenue retention is 112%. That's strong. They're witnessing strong consumption trends, not only from AI native, but traditional sectors. Quote, we are seeing strong consumption across the board, not just in search, but also in observability and security. So I won't walk you through all of this, but this is our AI going through their highlights. Green is good. You can see there's a lot of green on the screen. The weaker part, what about the weaker part? Let's take a look at this. So it's always important to look at the bear case on Elastic. It's valuation, execution risk. There's always execution risk. Competition from Datadog and MongoDB. That's legitimate. Okay. You'd want to look at those two. I think you'd want to look at those two names and do a comp. I think across those two names, though, Elastic is just a lot cheaper. We looked at those two names already. Elastic is a lot cheaper than both of those. So you get more valuation, right? What else? Let's see. NVIDIA earnings. I had an FSD video Wednesday night on the night of earnings on NVIDIA. So you guys can check that out. We link to it in our newsletter. It's 20 minutes long, and it's a deep dive in the whole data center thing, what's going on there. So we'll have to have our friend Michael Preck back on soon. We'd like to have Michael on each quarter or so. So we'll deep dive into that. But yeah, headline is like the data center theme is real. The fundamentals are real. The build out's real. We still have years to go. If there's a bear case, like I'm actually not super excited about data center, just technically for technical reasons right now. I have exposure. I have a benchmark weight to NVIDIA right now, just benchmark. We actually sold some NVIDIA when it hit 5 trillion market cap, by the way. It's like markets love round numbers. 5 trillion, it's congratulations, now I'm going to rug pull you. It's funny. That's what markets do, right? Just that people get giddy. And then, let me see if I can find this tweet for you guys. It's somewhere there. But so we're maintaining a benchmark weight. The fundamentals are there, but sometimes things can get over positioned. And it is part of this high beta story. It's got some animal spirits around it. So it's not as clean as some other ideas. I have mixed feelings on it right now, actually. And we haven't sold NVIDIA in a long time, by the way, but we did de-risk a few weeks ago, and we just very recently bought back our position to a benchmark weight. We'll see. But I think other names on the sector are totally like dislocated and could do really well. Again, we're secular bulls on the thing. It's just, this is about timing. Okay. Michael Berry is not a great investor. Okay. He's just not a great investor. He got priced in. Oil prices are low. That's great for the consumer. That means more disposable spending. By the way, you know what the interesting things are when you look at what were some of these animal spirit top signals? One was when JP Morgan raised $1 billion for IonQ. Do you remember that in October? Be careful of what Wall Street is selling. JP Morgan, $1 billion. And they initiated with a neutral rating. Neutral rating is code word for sell. Okay, so I think the mistake people will do here is they will go buy the favorite names that they've owned for a long time on the dip, but the dip might keep dipping. That's my concern of where we are here. I think Animal Spirits had an incredible run, and you have to rotate. You have to rotate. Then when you see the parabola, take your gains, count your blessings, and rotate. That's it. You kind of have to run to the opposite side of the room, actually. The least crowded side of the room, right? After the dot-com bust, I'm not saying that's what's happening here, but the entire market revalued lower, all the sectors, all the styles, but the sector that started outperforming and doing extremely well was small cap value, which is the exact opposite of large cap tech, like a style box, right? So maybe that happens here. It's hypothesis. If it keeps working, we'll add to it. That's how we're looking at that right now. What else? At a sector level, I like communication sector quite a bit. Let me show you what I'm looking at. So I do like the communication sector. So here's the communication sector. I'm looking at the valuation on this, and seems interesting. Seems like an interesting level to go buy in at. What are the leaders in communications? Meta. That's an interesting one. Now, this one's gotten hurt because they're behind on AI, but look at the level where it is now. At forward PE of 19.9, I think that's a good buy. This is just narrative stuff washing over the stock. So if you can time the entry, I didn't nail this. I got entries like here and then waiting and then adding a little bit more. But I think this is a good one. And Fox stays another communication stock. This is an interesting baby boomer theme too, right? Aren't baby boomers watching Fox? So this is an interesting idea, Fox. There's more to it than that. I don't have a large position in it, by the way. I'm just giving you examples of communication stocks, ideas. So another one, maybe is Staples. I've been a hater on Staples for a while, but if I look at Staples, this thing has pulled back quite a bit, and Staples are characteristic quality stocks, actually. A lot of what Warren Buffett owns are staples, the kinds of things he would own. Think like Coca-Cola, Wrigley's, Gillette, staples, right? Costco would be in this mix, which I'm not interested in, but so would Walmart, which is pricey too. But maybe there's stuff in this. Maybe there's stuff in the staples area worth poking around at. If you find something, let me know. You can see some of the constituents in that category. Philip Morris sold off quite a bit. It's still not really at a bargain level, though. I don't know. So I have mixed feelings on staples, but my process is saying maybe you should look at staples. What else? Let's just take a look at some of my notes I have here. Yeah, I think consumer discretionary is going to do well. I think financials will do well too. I think financials they reported really well. They reported strong numbers, and then they went on sale. So you can buy these things with the benefit of hindsight. and the DQs are fine, delinquencies are fine, all the rest. But I do think positioning in these categories matters a lot. I don't know that the big banks around the world, including the mega caps, are where you want to be. Let me show you this one. This is beautiful. I'm cherry picking here. This is a beautiful picture. This is GSIB, an ETF. So this ETF contains the biggest banks around the world. Okay. What we saw here is this thing went parabolic on November 13th and we just sold it right there. Do you see that? Boom. Maybe it settles here though, possibly. We think banks are still a great theme, but we think maybe the regional banks are where you want to focus. So that's where we've been allocating to, but the technicals aren't clean in that area though, unfortunately. So it's not as nice as say communications stocks right now. We just know the fundamentals are good. So we're just waiting for it to set up nicely for us, right? What else? Areas that I'm avoiding would be like industrials. These are these big defense stocks and all this stuff. This stuff is a hot category, industrials. Let me show you industrials. I'm going to share my screen with you all now. So this is a pattern that when I see, I'm like, I'm not interested in owning this thing. This is industrials. Take a look. I don't like this. I think that area here, I think that's the top right there. And this is, I think, goes nowhere for a while. So I'm not interested in that category. GE Verona is in there, defense stocks, Eaton, Uber, maybe Uber though. Uber might be the exception to the rule though. I've been watching Uber. Uber looks interesting, doesn't it? Uber might be the one interesting thing in industrials. Okay, so what else? Taking a look at the rest of the newsletter here. Yeah, we've got some good curations. We've been building out the Lumina Health Twitter. So if you guys want to stay on top of health and longevity, stay on top of that. And oh, this is funny, right? Did you guys see this one? Let me share this meme with you. At the bottom of our newsletter, we always put a meme, a funny meme. This is funny. I like this one. This is the bottom of the range where it's, hey, crypto bros, we are hiring. careers.mcdonalds.com. So McDonald's apparently had record applicants. So I think that's more of a sign of the K-shaped economy. The lower end isn't doing too great. I think it's more of a sign of that than anything else. But the high end of spending, that's what actually matters. That's actually what matters for driving growth. I think I'm all set. If you guys have any questions, feel free to drop them in here. Otherwise, I think I might check out and go hit the sauna tonight and get a good sweat going. Good way to start the week. What else? So yeah, check out luminacopilot.com. If you want to get on the early access to our app, we have a big release coming this Tuesday, including real-time news feeds, and it's pretty cool. That'll be fun. And then I mentioned we have a bunch of events we'll be planning. We're also going to tokenize Lumina stock, which is pretty cool. I've been debating this for a while. I said, yeah, we've grown through our community and through our audience and people like you listening and joining us at our events and through referral organically. So like, why not? I think that'd be a good way to catalyze and accelerate growth and enlist the community in our future plans and drive adoption, like our products and events. I think on the event side, what we realize is that we are in the age of loneliness. There's a lot of talented entrepreneurs that are working so hard. They don't have time to develop their social connections and community. They come up for air, they look around and they feel isolated. Let's bring them together. We see them at our events and they appreciate the camaraderie of talking to one another. That's one customer segment there, but I think entrepreneurs need a home, especially when capitalism is being attacked, right? Let's create an environment focused on entrepreneurship, health and wellness and longevity and business building, right? The leads and needs exchange. We're still trying to define the vision of that a bit more, but I think there's a need for that in the market. And can we have that map into the digital world too, whether it's on Telegram or through our app, and let people connect with one another, right? So more on that to come. We're still thinking through it, but we're making some super interesting investments. Excited about launching our ETF. Hopefully it's Q1. We're building a lot. We got this AI app, we got this ETF, trying to buy an FDIC insured bank. So we just got to balance things. And we're hiring leadership. I'm looking for a VP of client service. So if you know someone that they have to understand wealth management, CFP, trust and estates planning, they should be a techno-optimist, forward-thinking, hip with AI, driven. If you know anyone like that in the New York, New Jersey area, let me know. Great opportunity, excellent opportunity. So please send us referral around that kind of role. All right. With that said, I will call it a wrap. Stay tuned. We may have another show for you this Tuesday or Wednesday with Michael and or another guest on AI. All right. Take care, folks. Be well. Cheers. Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.